There we go. All right, so let's go in order reading these off. So this was the facts that we went over Tuesday, I guess it was. Let's start here. Isaac, read off fact number 1 and then work our way down that side of the aisle.
Stocks are not the most important source of external financing.
All right, what does that mean? Let's read it and give your interpretation of what that means. So Isaac, what's your interpretation of that? Give us a little more details.
I mean, there's more than stocks out there, and stocks go up and down.
Okay, what's a stock?
Stock is a piece of the company that you own for a little while. You give them money to own a piece of pie of their business.
So what's the point about the external financing? It says they're not the most important piece of or part of external financing. Somebody else help them out? External financing. What is external financing? I guess is the one place to start.
Funding coming from the outside.
Yeah, funding coming from the outside. So you can kind of use the word external. So what are other sources of funding?
Private loans.
Loans. So you want to expand your business, go get a loan, go sell some stock, right? That's kind of just equity versus debt. You can sell a share of your company, right? So you started a business, you own 100% of it. You need to bring a partner in. They've got some money and maybe some expertise in some other areas. Hey, I'll give you 50% of my business if you give $50,000, right? So I'm contributing what I've done so far. I value it at $50,000. You bring in $50,000 cold hard cash. Our new agreement is a partnership. I'm a 50% owner. You're a 50% owner. Boom, away you go, right? So that's an equity way of funding. Yeah.
After the initial IPO, are stocks really helping the company?
After the initial public offering?
Yeah.
Are they what?
Are the stocks actually help the company at all?
Help a company?
Yeah.
No, not really.
Like you said, because like me buying $20 worth of Apple stock.
No, because that's the whole point of it. Yeah, that they don't do anything in terms of raising additional funds for the company. They can start to do stock buybacks and own some more, but that's really not. That's just reinvesting your profits rather than anything else. So yeah, the company does not get any additional funds once the stock is. It's just an asset that's being traded among that's why we call it the secondary market, right? So the primary market is the initial public offering, where that went out and raised some money for your company. But once it's out there, it's in the secondary market because the primary party is no longer involved. So it's just secondary parties that are involved. Okay, Liz. Okay, so we're not using those securities as the primary source. So marketable securities would be bonds and stocks. What is the primary source of funding that we learned last time? In the United States, at least. Banks, right? So we have banks, and what was the other source of external funding that's actually pretty powerful in the United States, especially, not in other countries necessarily? The other indirect finance. Bonds? Bonds, no, well, that's the marketable security. So yes, it's there, but you got banks, but you've got, what are some of the non-banks? Non-banks that are sources of funds. Somebody said it before, and we've certainly had it up there. What are the other financial intermediaries? You got banks. Yeah, Liz? No. Well, I mean, we did talk about the Fed, but not as it relates to them being a major source of funds for banks, right? Private companies don't go to the Fed for funds. The Fed might make funds available for other banks. Lots of
like hedge funds.
Hedge funds, possibly. You're missing the big shark that you guys need to be aware of. Not necessarily shark. Yeah, not a lone shark. Shark is probably the wrong word. But whale, the big whale in the room is what I meant to say. We talked about it a lot with adverse selection and moral hazard. We had lots of examples. Nope. Yeah. What do you pay? Who do you pay your premiums to, everybody?
Insurance.
Insurance! Come on, people, wake up! Insurance companies, right? So the insurance industry was huge. So that is another source. Jonah, next line item here. versus indirect?
I believe direct was when
Okay, grandmother one. And so who's indirect?
indirect was when the
Which one's a bank? Which one, so the bank is indirect or direct? Indirect. All right, next.
Banks are the most important source of external funds.
Okay, banks are the most important, so we have them as there. We'll get Samir off the hook there. 5.
The financial system is heavily regulated.
All right, we all know that too, so you're off the hook. Caitlin? Okay, so what's the issue with that? Let's pause on that one for a second. So why is it that they have access to securities markets?
They bring in enough to not have
To not have a what?
like they're less risky.
Okay, less risky, a little more trustworthy. Anybody else want to add? I saw a bunch of hands up. What's that? Credibility, right?
What
So
economies of scale have to do with that?
possibly that, they might have enough reserves, high enough profits that they can, so whatever. So there's lots of different ways to measure that, but the securities markets are the tradable bonds. So there's a trust level of, if Jeremiah buys it, nobody at General Motors knows Jeremiah. He wants to sell it. Isaac doesn't know Jeremiah worth a darn. He doesn't know General Motors. General Motors doesn't know Isaac, but yet Jeremiah can sell his bond to Isaac. You see what I'm saying? That impersonal nature, the more trustworthy, the more well-established they are, the easier it is to make that a tradable, marketable security with nobody actually knowing each other. That's powerful. All right, number 6. Or 7, sorry. All right, what was the collateral? Car for a car loan, right? So some sort of asset is pledged. If you don't pay your bills, then you're going to lose that asset. JC, last one.
They contract for numerous restrictive covenants.
Okay, what was the covenant idea?
That means that some contracts have certain restrictions from a company to not for a public company.
Okay, good. So on what you can and can't do. So this last little thing here, or this next thing I should say, not necessarily last. So we had those 8 facts, and we talked about extensively on adverse selection, moral hazard. Which one's pre-contract? Adverse selection or moral hazard? Adverse selection is pre-contract, moral hazard is post-contract. Moral hazard, why is the principal agent problem in parentheses under moral hazard? You see?
General insurance company wants you to do something like the person who's doing insurance.
No, you're kind of almost too specific. You don't even need to go into an example. Which one's pre-contract, which one's post-contract, which one's moral hazard? Post-contract. Why is principal agent in parentheses under moral hazard? So JC gave one example of we gave a real estate agent and a seller of a home, an employer and an employee. So we have these problems where that might happen. Yeah.
The agent or the principal could be hiding something from the agent, like in the real estate example, they might be hiding that something's leaking in the house and the agent's.
They could. So there's an asymmetric information between the two.
Yes.
Right? But why wouldn't principal agent problem belong under adverse selection too? Is why it's parentheses under moral hazard. Daniel?
Because it matters more after the purchase.
Okay, and can principal agent problem live in adverse selection? No. That's the whole point of it. You've hired the person. You've inked the contract with the agent, right? So principal agent problem is a moral hazard issue. It kind of falls under that category because it's post-contract. All right, so under each one of these then, adverse selection, let's see, what am I doing with my finger, I guess. So private production and sale of information for 1 and 2. 1 and 2 was stocks are not the most important part of external financing. So private production and sale of information. So what sort of information do people gather pre-contract? Remember, adverse selection is pre-contract. So all of these items, we're kind of thinking pre-contract. What sort of people are out there selling information? What kind of companies? We've talked about a few of them already. Or how do we produce information, private production of information? If you think about your insurance company example, it's kind of like, how do we overcome adverse selection? How does the insurance company overcome adverse selection?
One company that evaluates risk.
Okay, so we have the Standard & Poor's and the Moody's, the bond rating agencies. That is the sale of information, right? We talked about the subscription service and how they might be part of that. So items 1 and 2 with marketable securities, we can have rating agencies and other people producing information, like private production of information for the stock market being important or marketable securities, is that you can do your own research, right? You can have a staff member that was a business economics major at Ottawa University, and you can say, go check this company out. You're producing information when you do that, right? Okay, so then government regulation to increase information. So that was for item number 5, which we see that the financial system's heavily regulated. We're going to challenge that a lot. Like, do we need as much regulation? Regulation pendulum kind of swings back and forth. Or are there private ways to do it? Does it have to be the government? Collateral for number 7. So adverse selection, hey, I'm not going to give you a loan. How do I prevent losers coming to my table? I say that, hey, you're going to have put some assets up for this loan. You want a $100,000 loan? I need assets of about 50% before I give you that kind of loan that are pledged. And so then the losers are not going to be able to come to the table, right? So we have ways of using collateral to offset that. Number 1 with moral hazard, stocks and external financing, how people behave after we can produce information. But after the fact, post-contract, it's most likely monitoring. So the bank might require you to provide financial statements every quarter or every year at a minimum, is what we had with our loans that we did in real estate. So every year you had to kind of give a full financial statement, and somebody at the bank is being hired to actually look at your numbers, not just put it in a file. They're going to monitor to see if your creditworthiness has stayed out there. All right, and then government regulation, again, with moral hazard and increased information. We got monitoring from the government on the moral hazard side of life. Financial intermediation. So that's the go-between here for item number 3. Indirect finance is more important than direct finance. So we talked about the importance of having the bank be the middleman because it's can mitigate the risk. It's basically just a business that's willing to take on that risk. And then in debt contracts, again, the collateral, monitoring and enforcement, and intermediation. So that just kind of gives a nice little summary of trying to piece together these concepts we did last time of adverse selection of moral hazard as it relates to some of these issues in the financial sector. All right, questions or comments there? All right, well, let's do some problems. Let's get into groups again. These are going to be even tougher problems. Minimum of 3 people, maximum of 4. Minimum of 3, maximum of 4. And shoot, I forgot about my online. You guys are on about that.
Yeah. Sorry, Jeremiah,
We offered first.
you can go with
We just thought it was harder.
On the arm. How long do you got? Are you taking that off?
No, not yet.
Not yet.
So I won't get out of this until.
All right. Does everybody have a group here? So you're coming up here, Brady.
Yeah,
This is your group. This is your group. Marco too. What's your group here?
Yeah.
Because these guys only have 2. They need a 3rd. Oh, Brady came. Everybody good? All right. So let's start on. Probably doesn't really matter where we start, but I want to start all together. Let's start with this problem. So number 22. Bryce, this is problem number 22 in your textbook, but I'm gonna try to email you something here to get started.
Yeah.
You get it? All right, Bryce, for now, I'm going to turn you, and you're going to join Lawson and Jeremiah and Kayla if you have any questions. I know this is a little bit awkward, but there they are working diligently. But when you speak, the whole room's going to hear about the chair. So you guys will be talking and working on this.
Oh, I know. We're doing already.
All right, let me go grab my
I know if how much are you? Oh, yeah, most of the space. Well, I have to. Is there any questions? I have a question. I would start it. Oh, yeah, that's right. This one says that you want to do that's what's different. At least I think it's got to be because you're going into the really. I think it's but then
Once you're done with that question, you're free to move on to the next question.
Yeah, I mean,
Wait a second, that does not make sense, man. There's the common sense answer, but not the economic answer.
Yeah.
I think that's a misstatement. That is not possible. That's not true. I would say the common answer.
I'm worried about how complex.
It don't make it that complex since I actually have them.
Wait, so you care about the effective value of the car you buy. Because the car values are so you know just as much. So like if he knew that you're gonna trust his word a little bit more, you dig maybe a little more. Yeah, you're gonna believe that it's worth $20,000 less than that. You're gonna believe that it's not undervalued. Why? Okay, so now he goes more. How much you?
Bryce, are you still there?
Yeah, and everyone on the same.
Yeah, I'm still here.
Okay, I just sent you the sheet of paper that these guys have in their hands, so you can just handwrite it on your notebook paper as you answer.
Okay, thank you.
You guys came up with 20,000, 15,000. What's the expected value for number 22? 20,000. Gotta work on that a little bit. What'd you get? 20,000? That's wrong. It's a specific number between 20 and 24,000. Did anybody get it right? That's correct. That's correct. That's correct. Wow, we got more brain power over here. You guys, come on. Left side, poop it up, poop it up. Right side, got it. Your answer, let me see your other one. You get to that. Yeah, you need an explanation. There's a lot more brain power needed for that one, and 24,000 is the wrong answer. But you guys get to the second part. Wrong. Work on, I want all of you to be working on part B. I haven't seen the right answer yet for 23. So it's kind of the part B. You want to check in? Did you guys get your 22 done? Lawson's got it right. So you got a 50% chance of getting 24. You got a 50% chance of getting a 20. You don't know which one you're going to get. So the expected value is the average of the two. So the expected value formula. So we're using the expected value of a random variable x is equal to the probability of getting value x1 plus the probability of getting value x2. 20,000, 24,000, 50% chance of getting 24, 50% chance of getting 20, answer 22. So some of you kind of just did the division, and I wouldn't want you to do it that way. You should lay out this formula. Because another problem might say you've got an 80% chance of getting x2 and a 20% chance of getting x1. What's the expected value? And the weights would change. So this particular problem was the old 50-50, so like JC did divided by 2, but that divided by 2 is not always going to work. That's putting equal weights on both.
So the next one will be 0.75.
23.
What I was thinking was if you not know less information, the probability of getting 24 go up, but you still have the chance to get the lower.
So let's walk through this one together. Bryce, I think you can see me on the other camera if I remember right. So hopefully. So as a buyer, how much were you willing to pay? What's your expected value of the car you're going to buy? What's Daniel? 22,000. 22,000. So how much are you? What's the maximum amount you're willing to pay? 22, given the uncertainty, right? So the whole idea is I'm either going to be happy or I'm going to get screwed. So because I think the value is going to be 22. So the most I'd be willing to pay is 22. Now, is the seller going to want to sell their $24,000 car to me when I'm only willing to pay 22? Think about economics here, not real life negotiations, right? No. So that's where maybe I'll take Ayla's thoughts. We got to work through the theory here first. So no, and in fact, so now the seller, knowing that nobody's going to want to sell, and the buyer, knowing that there's no good cars out there, they start to revise their calculation, right? So because what are the cars that are out there now? If 22, if you can get them at 22 or 20, so now what's the expected value of the car? 21. So the lemons problem is this. We're going to keep logically revising our estimates. We're going to keep revising our estimates down, and the good cars are going to not have a market any longer for them. So this was one of the research paper on this was the guy got a Nobel Prize for on what's called the lemons problem. And so the market's failing because of asymmetric information. The buyer doesn't know which ones, they call it the cherry or the plum, and which one's the lemon. So the plum versus, I don't think they use that, they didn't use that language here, but I think maybe your textbook uses it. So is the car a cherry or a lemon, right? And so we don't know, so then the market will start to gravitate as people ratchet down their expectations to the lowest price. And so now we're down to only lemons being sold because that's the $20,000 car. You're getting what you expected. The car was a lemon, right? So the market fails to provide a solution to getting the $24,000 cherries sold. So what do sellers do to signal and eliminate and try to mitigate or reduce the asymmetric information? If you're holding a really good car and you know it's good, and you know it's not going to cause this person problems, what do car sellers do? No, we're going to hold it at 20. It's only worth 24,000. So there's nothing to jack up. I mean, that is the market value of it.
They ask a professional for appraisal.
Okay, so you can do appraisal. What else do cars sometimes come with for 30 days or longer? Warranty, right? I know that I have a cherry. I will gladly sell you this car. But wait, it might turn out to be bad. Well, I'll tell you what, if anything goes wrong with it in the next 30 days, I'll fix it. I'll pay for it. So give me my 24,000, right? So now, through the use of a warranty, we can have a market for those cars. So that is the classic problem or the classic case of the lemons problem. And so this evolution of rating systems, getting 5 stars and reviews and all of that, trustworthiness, all is an attempt to reduce the asymmetric information problem, right? When you read that a restaurant has 5 stars all the time and it's reasonably priced, then you start to feel comfortable. Yeah, I'm willing to go in there. They're a little bit higher than their competitor, but they got good food, right? So you start to know and you'll go there more often. All right, questions on that? So revise your answers as needed here. No, you're going to keep ratcheting down your information until you get to 20,000. It's kind of logically where this exercise would take you. And so then the market for the cherries doesn't. So the way to overcome that is to do the warranty. All right, now continue on that other side. Some of you were working ahead, which is fine, but see what you come up with on that one. Alright, so we got lazy worker, hard worker.
So is this saying that we, like 20% of the time, he doesn't have, or 20% of the time when he's working hard, he makes $10,000 profit?
Yeah, that's the profit that they bring in if we get a hard worker.
Anybody only works 20% of the time?
Yes. Yes.
So
You got the same thing with the probability of what you're.
So if you were smart, if you've got 20%, make it 10,000, 80% make it.
You talk to your buddies about that.
Is this set up in the sense of like?
So this next problem with the hard worker, lazy worker, you definitely want to use that equation up there. I want to see you lay things out.
No, I'm saying a second. I'm already on second.
No, do you need to go for the first? That's what we're
I'm on the second part. See what I'm doing here? So I think it's on the first and then. Track that out. Okay, working hard, working hard. Got it.
No.
Yeah. Yeah. Make sure Oh. So then we would want to use
Yeah, you're getting close. You're dangerously close. You look like you're off by a decimal place.
No,
Go back.
You know that guy.
Ask back to your friends. You got some smart friends over there. I'm not gonna look at that one. Not until you get the first one right.
So. What is your?
Okay, so what's your answer? Alright,
I'll show you. So you got that part, so now you can set. You want to.
you were done before I even started. Go that way.
So you set that right up in.
No.
26.
Talking about the right track, but yes.
It's 42.
You gotta fix up, so what is this?
If, so the top one is the,
Okay, so how did you go about trying to solve the one?
minus 1,000.
Where's your question for that?
okay, yeah, so what it is,
So that-
is these are
set that
probabilities.
greater than
So it's 68,000 feet. And then we're looking for anything greater than that, question. So then really anything greater.
Oh, okay. No, you have to offer, so now this is basically the expected profit. And he's gonna be somewhere, one or the other, depending on if he's hard or lazy. But what you wanna do is figure out how much should I offer Ron or different between these two.
Yeah,
But you're gonna get one down to the cross card, let P be like his cut, like, you understand that would be the owner's profit, right? But now we're gonna give him a fraction.
So you say 60,000.
And figure out where Ron is in different company working on lazy here.
Would be like the, right there. Would be-
You're gonna work with those two numbers, yes. Work with your smart people in your group, and figure it out. I said 60. Okay, yeah, That's a little better.
What'd you get? Okay.
Okay, so yeah, you guys are at the same spot they were, so now, this is really the expected value for the owners, right? But now what we want to do is cut of that,
Start by
such that P is maybe different
Yeah. 5 by 6.
being lazy or working hard. So what percentage kind of goes on, and then to make it a difference, you're setting those two equal to each other.
I see.
Maybe you can doodle that for you.
Yeah.
No.
Now.
What did you do to do that?
Just makes me try to keep it.
I'll say it would be.
Now the one divided by 2. So now you've got these other probabilities. So you need to go back to following the expected value. And the way you laid it out, the way Bryce had it laid out, that's the right. You're not around. Okay, that looks good. No.
Yeah, so
26 is your average.
I'm just.
So then, yeah, you do need to factor this out, which you did here, which is fine. But now you gotta set, you wanna make Ron and difference between these two. You need to find it, so this is really the owner's profit, right? And so Ron's cut currently is 0. And so now Ron's cut, we want to make a fraction of that. Or a fraction of this, which is actually a 40 minus the fraction of minus 3,000. You set those two equals.
So it'd be 400,000 divided by 15 years on average.
All right, let's see. What happened? Did I lose my pen or media?
That class either made you feel like or
All right, who's got I think it'll be easier for me to do it on the board. Who's got a pencil I can borrow? Oh, you got it. I don't want to take the one you're using. Write it. Well, I want the next one. Oh, you got it. Okay. All right, so one thing that you want to look at here with this problem is setting it up correctly, of course. So the expected value of the profits you guys got, but we want to think about this a little bit differently. Now let me run through what you did. So 60% times the 10,000. And what I want to do is come up with a percentage profit sharing plan for Ron that is somewhere between 0 and 1, right? So our current plan, Ron gets 0 and the boss gets everything. So we're going to kind of try to come up off of giving a profit sharing plan. So what we're really calculating here is the number to Ron of, this is the lazy one. So we're going to multiply it times this fraction P. You don't have to have it perfect. Some of you already solved this correctly, but I think it'll be instructive if you watch me set it up if you didn't do it this way. So plus the 40% chance of getting $50,000 times P is the fraction we're going to give Ron again, is 26,000. So a lot of you had 26,000, but now we're just multiplying it times the fraction we're going to give Ron. So we're thinking about Ron, not the employer. So the next one then, on the expected value with him being a hard worker, is equal to 20%. We can kind of look at it this way: 20% times 10,000 P plus 80%, 50,000 P minus 1,000, right? Because Ron has personal cost of 1,000 to exert himself. And that equals 42,000 P minus 1,000. So the expected value of working hard for Ron is that function and this function. And now where is Ron indifferent between being lazy or working hard? You set them equal to. So you want, on a problem like this, you're going to take the expected value of being lazy and set it equal to the expected value of being working hard. And so 26,000 P equals 42,000 P minus 1,000. Solve for P, 6.25%. And so we need to have, that's where he's indifferent between it. So ideally, in order to get him working hard, we probably want to be a little bit above 6.25. But that's his point of indifference at 6.25. Anybody have any questions on that one? So the point of this is try to train yourself. So a lot of you are trying to do some stuff in your head. I think it would work this way or that way. Try to kind of start training yourself. This is how you get trained in economics, is you start thinking about this formula. You start living it, breathing it, eating it. So that eventually you hit a problem like this and you're like, oh, this is a probability problem. Let's look at what the expected value is. And it's not that big a deal once you kind of get the nuts and bolts of it. Now setting the indifference, this thing was a little more complex of a problem, setting these two equal and finding the point of indifference. So, did anybody of you that did it that didn't lay it out to me this way? Is this what you were doing in your head, or do you have any comments or tips for other people on how you saw it? I know JC, Kaylin, McKenna, you guys kind of had it early. Somebody else had it kind of early. Yeah, you guys did. Anything or that you want to add that? Because math can be done multiple ways. So I'm genuinely asking if you had other tips or ways you saw the problem that helped you solve it.
Just to make it simple for me, when I did it, basically when you get that 26,000 P and then the 42,000 P minus 1,000, in your head, all you're doing is subtracting the P's and then taking that number over 1,000.
And did it over 1,000.
So it's just 1,000 over 16,000 that gets you to.
Which ultimately you're solving for the P.
Yes, but it's just, when you think of it in a way that's instead of putting it before you skip
Oh.
that step, you just
You just kind of started solving it right away.
Yeah.
One or the other. Okay. All right, work on the next one. The next one's a little challenging one too here. Mario's Nate was howling too. Mario's second is howling right here.
Okay, so you want to find out what's the
8,000. Yeah, that's the, with and without. So this is okay. And then what about without risking too much? Without C-walls or any other partial.
I'll take the forward, and
Then
then
we get the,
I'll
you
multiply
got
that
82 again?
by 25% because we need.
Oh, we'll talk to your buddies.
Sorry, the one with the 55%.
This one is what? I see. Definitely without the C-wall, right?
So I'm not solving.
The partial, then that's the one that.
I'm not solving for
So the full insurance is, this is the answer for full.
And you would do that, that's the
I don't know. You'll find it. Figure it out with your buddies.
As long as you have a 75%, I'm going to play with the account.
Oh my gosh, look at that. That's probably not right.
Okay, the 8,000, 2,000 is good, yeah, with the full insurance.
I'm
That's why to start. With partial?
Yeah.
Why?
Because you're still, well, you're still paying a different fixed amount over a budget, but once your house is busted, you're gonna have to pay that extra amount. So,
But so think about from the insurance company's standpoint. working here.
So like,
So let's kind of make sure we're all on the same page with this full insurance, partial insurance. So you own a house, 400 grand, the river floods, completely destroyed. This happens once every 50 years. You build a seawall, river would flood, destroy your house, which happens about every 200 years. What would be the annual premium for an insurance policy that offers full insurance? What about for a policy that pays only 75% of the home value? What are your expected costs with and without the seawall? I haven't seen any of you get the right answer yet on that. So you're going to get only 75% of the home value is what you're going to get with partial. So partial insurance means like when you get in a car wreck and you have a deductible of $1,000 deductible. There's $3,000 worth of damage. You pay $1,000. The insurance company pays $2,000. So think about that. And do the different policies provide an incentive to be safe?
Let's take away this there.
I still think you're paying the same amount. Payments.
Yeah,
You're still paying $3,000.
Yeah, but like you're paying like 6,000, but you're still gonna end up paying more.
That one.
Oh.
Because your payments are gonna.
So now you got to deal with these answers
Plus, you're gonna have to pay.
versus those answers. That's kind of what this is saying. These are different policies provide incentive to be safer. So what are your expected costs with and without the seawall? So yeah, you got, yeah.
I don't know if he wants the cost of the insurance or the cost overall.
Sure.
Are you asking if we want the cost overall or just for the insurance?
What?
Are you saying that we need to find a cost overall or just the insurance?
No, just the cost overall is what you're looking for to look at the difference here. That basically ends up being your insurance policy, right? And whatever the insurance. Let me back up a sec on why we're calculating expected loss. The homeowner might not calculate it, but does the insurance company calculate it?
Yes.
Yes, right? So this is how real life actuaries and insurance companies, that's why this formula is so important. This is the game they play. In the real world, you're either going to have the house flood or not have it flood. And if I have 1,000 houses, what is the fraction? They play a large numbers game. They are a casino, right, that is allowing people to come and gamble. Some people are going to win, some people are going to lose, but is the house going to win or lose? The house is going to win, right? And that's what they're doing, is they're playing this game of, I'm going to offer you an insurance policy of something less than, if the full insurance premium, 8,000, 2,000, whatever that expected loss is, that's going to be the premium. So we're just going to assume that the insurance company is going to give you that premium, the expected loss, and then you're going to have your place insured. So the insurance company is playing a large numbers game, and that's part of why this expected value of the random outcome is important. So that is the premium. Yeah, this is kind of all part of the adverse selection, moral hazard stuff. Well, in reality, the insurance company is going to have, you're going to have, this gets beyond what we're trying to do, but risk premiums, and so people are risk averse, and so they're willing to pay more than they expect value, and that's how the insurance company makes profit. That's kind of what's missing on this part. So we're finding the break-even point, like you said. No. All right, let's kind of work through this one. I think everybody got this, right? So full insurance, we got the expected loss without the seawall, 2% chance, $8,000 expected loss. With the seawall, 2,000. So the full insurance premium, what you pay the company, would be equal to the expected loss. And what I was explaining to JC is that in reality, insurance companies know that we're risk averse, And so you're willing to pay more than the expected loss actually for your insurance company. And that's how the insurance company makes profit. They're willing to take the gamble, and most people are not. So then with the partial insurance, it's just 75% of the house value. So you kind of run through the calculations again. Partial insurance equals that. So that's what your insurance premiums are going to be. But then you have, this is the part I don't think I've had anybody lay it out like this. Without the seawall, the expected loss to the consumer with the insurance policy, you got a 100% chance of loss of the $6,000, and then you got a 2% chance of the $100,000 difference of the co-insurance that you're paying, right? So you have a 2% chance of having to pay the 100 of your $400,000 house, giving you the 8,000. And so that's again your point of indifference between the partial insurance and the full insurance. So the moral of the story related to the problem then is, are you going to build the seawall or not? You will build the seawall if the annual cost of maintenance is something less than $6,000. Then that would be a pretty good deal for you as you analyze it.
Can I take a picture of this?
Sure. Actually, it's all being recorded. Well, yeah, this part might not be on the recording. Yes. So that was from the 2% chance loss up here. So you have partial insurance, but you also have now a 2% chance of having to pay it yourself. So this is your personal expected loss when you only have partial insurance, right? Because you're going to have to absorb 100,000 of the house loss, and you have a 2% chance of that occurring.
And then you're guaranteed to get that 6,000. That's what.
Yeah, the 6,000 you're paying in insurance. So you have 100%. That's why I put this here is that you buy the insurance company, you for sure out the $6,000.
Okay, so on. So I was doing the homework earlier.
Yeah.
And this is one of the questions, but the only thing on mine is that this 8,000, 2,000 is the same answer for the 75% of insurance.
Because they were probably adding your expected, they were doing this part.
Exactly.
Yeah. Is everybody clear on that? Because that's an important point here, that when you do partial insurance, you are for sure going to pay your premium, but then you also have a chance of having to pay the deductible. And that's why Luke was saying in one of the homework problems, it comes out with the same answer, but it's for a different reason. Okay, well, let's put that one to bed. You guys can hang on to those so you can reference them when you do your homework and stuff. Any last questions on those? Otherwise, yeah, you can go back to your seats. We actually have a video lined up for today.
So if we think about it, dividing by 200 is the same as multiplying by 1 over 200. And 1 over 200 is, I get it. Right. Hello. Or 1 over 200 is 5.5%.
About time you answered. I'm talking through that.
Yeah. When I first saw
They're still up.
Makes sense.
Did it spell? Nope.
Wasn't it you who spelled last time?
It was Lawson. It was Lawson. It was Lawson.
All right, that's loaded. Okay, so we're gonna get into chapter 12. Let me spin Bryce around here. All right. So chapter 12 is on financial crisis. And we're really looking at not the financial crisis, but all financial crises. Is there a common thread that causes some economies to start to fail? And so your book has kind of this nice little chart here that walks you through the general idea of a crisis. Like, why do we even come into these problems? Why aren't markets more stable, or is it just inevitable that we're going to get into these problems, or is there something that we can do? So they break it into these stages. So in the initial phase of the crisis, whether it's financial or sometimes otherwise, but so we have a deterioration in financial institutions' balance sheets. What the heck does that mean? What's the balance sheet?
Assets equal to liabilities.
Assets equal liabilities and what?
Owner's equity.
And owner's equity. Okay, so the balance sheet for a bank has what sort of stuff?
Loans.
So bank balance sheet. This was kind of last semester. So on the assets and the liability sides, what are loans? Assets or liabilities? For a bank, assets. So we got loans. What are their liabilities? Their deposits. That's kind of the main shtick with the banking business, right? Now they can also own what on the asset side?
Mortgages.
Mortgages, which kind of be in the loan category, home loans or other things. Can they own government securities? Yes. So they can own some government securities, right? So it's just the government that basically has, it's kind of a form of a loan really, right? But it's a little more liquid and marketable and all that jazz. All right, so deterioration in financial institutions' balance sheets. What would be a deterioration looking at this simple little characterization I have here? How would this thing start to deteriorate? What's going up, what's going down?
Loans are going down, deposits are going up.
People are saving.
Yeah,
Deposits are going down or up? Up. So we got lots of people coming in with deposits. And that's deteriorating the balance sheet. So let's see. And so owner's equity, or the net worth or the wealth, however we want it, is equal to assets minus liabilities. So deposits are coming in.
Loans are going down.
And loans are going down. So if loans are, what would cause loans to go down or off the books as an asset? People pay them off, perhaps. Or if it's a crisis,
People aren't.
they aren't paying them, and we have to kind of say this is a bad debt and write it off and sell it off, maybe, or something, right? So that could be a problem. So that's it's the loans that are probably the big thing that are deteriorating balance sheet. During a crisis, maybe we're starting to see some deposits come in, but maybe they're going, but the main thing is those assets. So asset price decline, increase in uncertainty, adverse in selection and moral hazard problems worsen. What would be the adverse selection and or moral hazard problem during a crisis time? The chapter we just came out of.
Maybe people start selling and then more people start selling on top of that.
Okay, so their behavior is different, so that would be kind of moral hazard issue, right? Okay, what else? Adverse selection. What might the bank be doing that's attracting maybe some loans that they don't want? Or something, Daniel?
They're trying to sell some money, and so they throw like their morals out the window, like
Okay.
Background check.
So background check, they're not checking out the borrowers quite as closely because they need to get loans up. We got to get more loans. We got to get more loans. We got to get more loans. We could lower our interest rates for borrowers that might otherwise should be in a higher interest rate category, right? So that's kind of the adverse selection moral hazard problems that might start to go on as the bank's balance sheet starts to deteriorate. Then their behavior might start to be affected more and more by the adverse selection. So that takes a little bit of time, by the way. So this isn't all happening overnight, right? It's just kind of slowly like, hey, we're down a little bit on loans. Come on, guys, let's get to the sales floor. Let's pump up loans this week, right? So this is like week. So remember, this isn't all happening overnight. This is kind of slowly but surely. So this stage one might take a while. So now economic activity declines. As economic activity declines, are people able to pay their bills better or worse? Worse. So now we start to have, they're not depositing money, they're not getting their funds in, paying off their bills. That starts to increase this problem even more. So this, we stay in the stage two for a while. And then stage three, we get the prices across the nation potentially starting to fall. So things can start happening with inflation or deflation. In this case, they're kind of characterizing it as deflation, with nobody doing all the economic activity down. And you can't go, and we get to more and more problems. Okay, so I just wanted to kind of give you that as a framework for this video that many of you, possibly all of you, have seen. I've seen it personally 1,456 times.
The crisis of credit.
I never get tired of it.
What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together: homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But in the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of the deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells it to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment bank who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sticks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices. Safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in, and the bottom tray may not get filled. This makes the bottom tray riskier, and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice as a safe AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered in the homeowner's default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the term.
Adverse selection or moral hazard there with subprime, that spot that they just gave you. They start saying no down payment. Is it after?
I think it's adverse selection because you're bringing in that referendum.
You're bringing in that, so it's adverse selection because you don't have a contract with anybody, so you're thinking, who am I attracting with no down payment, no income verification? Oh, I'm a loser, I can qualify for that, right? So you're attracting that person there. And then once they get into place, maybe there'd be some moral hazard problems. All right, any other questions on the video so far? Now this is where it starts to get bleak. Yeah. I'll slide it.
So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker. It turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone and makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal, he puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000.
Moral hazard or adverse selection when these guys say, I'm not paying. Moral hazard.
They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country, and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy, the investor, to sell his CDO, but the investor is stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bond. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bond, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bonds. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
All right, that one just never gets tiring. So this chapter, chapter 12, is all on the financial crisis as we were just talking about. And so there's a lot of just reading comprehension. So what I'm going to do tomorrow is bring you through the details of some of these things on like a credit default swap and how this stuff actually works, kind of the intricacies of some of what was going on in the video. They didn't, I mean, just behind the scenes. But we're going to take a little more detailed look at that. So we'll see you tomorrow.